One of the most popular option strategies is the covered call. The covered call, it's essentially you buy 100 shares of stock and you sell a call option against it, and hopefully you profit from both the shares of stock and your short call. It's a fantastic strategy. It's very easy to understand. It's great for new options traders. Typically, the covered call is one of the first strategies you learn as an options trader. But as you gain more experience with options, you discover that in some ways there's a better version of the covered call that you could be trading. It's known as the poor man's covered call. So, the poor man's covered call, a more efficient use of buying power. And that really is the difference with the poor man's covered call versus your traditional covered call. Is the poor man's covered call, as the name implies, is just a cheaper way to do a covered call. It uses much less buying power. So let's talk about the problem with the covered call. So your traditional covered call strategy consists of buying 100 shares of long stock and simultaneously selling an out-of-the-money call option. Overall, the covered call is a bullish strategy. You actually make the maximum profit if the call finishes in the money and you get assigned on the short call, because if you finish in the money, you get assigned on the short call, you still get to keep 100% of the call premium, but you're now forced to sell your long shares of stock, but you're forced to sell them at a profit. So it's actually the best possible outcome, is actually your call finishing in the money. Now, I mentioned that the covered call is a wonderful strategy, especially for people new to options trading. It's very easy to understand. Really, the covered call would be the perfect option strategy, except it has one big problem. It uses a lot of buying power. It uses so much buying power. And the reason is because you have to buy those long shares of stock. Buying shares of stock is extremely expensive. Shares of stock are certainly much more expensive than just buying and selling options. So that is kind of the point of the poor man's covered call. Can we get the same kind of trade put on, but using nothing but options rather than having to include some long shares of stock? Yeah, we can do that. So the poor man's covered call, which is often abbreviated as PMCC, especially online, nobody writes the full poor man's covered call. It's a lot of typing. Everybody just refers to it as PMCC. So the poor man's covered call is an alternative to the traditional covered call strategy. Instead of using long stock, you buy an in-the-money call option to simulate owning shares of stock. So what this means is when I buy a in-the-money call option, a long call option that's in the money, because it's in the money, I could exercise that thing for 100 shares of long stock anytime I want. Because of that, it essentially simulates me owning shares of stock. It's like I have 100 shares of stock, except I didn't have to purchase 100 shares of stock. All I had to purchase was the call option, which is much cheaper than buying the shares. And because you use so much less capital, it actually means that the poor man's covered call is a much more efficient use of your buying power. So how does it work? How do we set up a poor man's covered call? Well, first, you go far out in time. So maybe you go 90 days, 120 days, 180 days, you go pretty far out in time and you buy a deep in the money call option. That deep in the money call option, again, it basically simulates you holding 100 shares of stock. That's what it represents. It represents 100 shares of stock. And then you go into a nearer expiration. Maybe, for example, if you bought the call at 120 DTE, maybe you sell a call in the 30-day cycle, right? So this is your covered call, right? So hopefully you profit from the short call, and maybe also you can profit from the long call as well. Ideally, if this thing doesn't move around much, you're going to keep the premium on the short call. Hopefully your long call gains some value, or at least doesn't lose very much value. And then what you could do is you could actually keep selling short calls. Once this one expires, for a profit, maybe you can sell another call, in the next month that pops up, because, depending on how far you go out with these long calls, you may have the opportunity to sell 3 or 4 different short calls along the way. Let me show you what I mean by this. If I go to my trading platform, let me do a poor man's covered call. I'll do it in QQQ because I don't currently have a QQQ position. The QQQ, by the way, is the NASDAQ ETF. So let me go into the options chain. So for me, on a poor man's covered call, I'll typically go out about 120 days out. So I'm going to go to the 125-day cycle, and I'm going to buy a deep in the money call option. Typically, I like to go about 80 deltas. So I'm going to buy this 410 strike call option in QQQ. And now what I'm going to do is I'm going to go ahead and against that, I'm going to sell a nearer dated short option. So I'm going to go into the 34-day cycle and I'm going to sell a 30 delta call. Now, overall, this is a net debit trade because that long call was a very expensive call, especially in QQQ. It's a big product. I had to spend $7,100 essentially for this trade, but this is still much cheaper because had I done a traditional covered call in QQQ, and let me do that. Let me go ahead and sell the same 30 delta call, but this time I'm also going to purchase 100 shares of stock. So let me click on the S price up here on QQQ to also add 100 shares of stock, and let me add the call as well. You can see instead of spending $7,100 on the poor man's covered call, I actually have to spend $46,000 on the traditional covered call. So think about that. $7,000 for the poor man's covered call, $46,000 for the traditional covered call. Which one is better use of my capital? So let me clear this out and go back to the poor man's covered call. So once again, I'm in the 30-day cycle. I'll sell that 30 delta call, and then I'm going to go back out to the 125-day cycle. Once again, I'm going to buy the 80 delta call. And if I go to the curve and analysis tool and look at the risk profile for this, it might look a little weird. For one thing, you'll notice that TASTYTRADE, which is the platform I use to trade with, it doesn't give me my max profit or max loss. And the reason is your trading platforms really can't calculate max reward and max loss on a trade that's diagonalized, because that's what this is. This is a calendarized or a diagonalized trade, meaning you have options in different monthly expirations or different expirations period. And because of that, the theta difference between the two can't really be calculated. Time's going to affect each option in a drastically different way. Also, Vega, the volatility aspect, is going to affect these options in much different ways. So it's really hard for your trading platforms to give you an accurate representation as far as a risk profile. But essentially, it is like a covered call. You actually want this thing to go up, and if it finishes above your short call, that is kind of your maximum profit area. Now, what is the max loss on a trade like this? Well, it is a debit trade, and like most debit trades, the most you can lose is the debit you paid for the trade. So in this case, this particular trade would cost me $7,100. That's going to be my max loss. So if QQQ over the next 120 days eventually finishes below 410, I'm going to basically lose all the money that I bought that call for, but I get to keep a little money for the call premium on the short call. But overall, the trade was a $7,100 debit, so that would be my max loss. So let's talk a little bit about the poor man's covered call versus your traditional covered call. So I've already mentioned that the buying power on the poor man's covered call is much less than that of the traditional covered call. Typically, you're going to save like 70 or 80% on your buying power. Now, how much you save, will depend on the deltas and the expirations you choose for your poor man's covered call, but it's going to be a significant savings on buying power. But of course, in the world of options, nothing is ever given to you for free. So yeah, you save a lot on buying power with the poor man's covered call, but you have to give up something, right? Nothing is ever given to you for free. So what do you give up? Well, you give up a little bit of profit potential. So you save on buying power with the poor man's covered call, but your max profit on the poor man's covered call is typically going to be a little less than the covered call. So typically you're going to make, like 10% less profit, 15% less profit. Well, again, it's kind of hard to nail that down because that's going to depend on the deltas you choose and the expirations you choose when you're putting on your poor man's covered call. But your max profit is going to be a little bit less. And the reason that you're going to make a little bit less profit on the poor man's covered call is because it has a little bit less positive delta. For example, when I went and bought that 80 delta long call, right? Well, that's 80 long deltas. But when you do a traditional covered call, you buy 100 shares of stock, and that is 100 long deltas. So the poor man's covered call doesn't have quite as much long delta. It also doesn't have as much positive theta than the covered call, because on the traditional covered call, you do have a lot of positive theta from your short call. The 100 shares of stock theta doesn't matter at all on stock. Theta is not a factor. But on the poor man's covered call, by adding the long call, long call is a negative theta trade, so it kind of offsets the positive theta from the short call. So all of that, just know because of the delta and thetas are a little bit different on the poor man's covered call, it does add up to you making a little less profit. So in the end, is it worth it to give up that small bit of profit potential for a large reduction in buying power? So in most cases, the answer for me is yes. I think it makes a lot of sense. Yeah, you give up about 10% or so of profit potential, but you save about 80% on buying power. For me, that is a trade-off that I will take pretty much like 90% of the time. Essentially, if it's an underlying stock that I don't want to hold the shares of long term, and by long term I mean years potentially, then typically the poor man's covered call is the better choice between it and the traditional covered call. Now, one last thing I want to talk about is exercise and assignment on the poor man's covered call, because this is typically the most confusing part to people when they're new to these things is, well, what happens if I get early assigned on my short option? You know, I don't actually hold 100 shares of stock. Yes, I've got the long call option, but what happens if my short option gets assigned? Well, know this, and we've talked about this so many times on this channel. Unless your short call is deep in the money and very close to expiration, early assignment almost never happens. You will almost never be early assigned on a short option. So as long as you're not holding options all the way to expiration, you will almost never be assigned on a short option. Thus, the easy way to avoid assignment on any short option is to just exit the position early. Do not hold all the way to expiration. Close the trade before expiration. But let's say for whatever reason you get assigned on your short call. Maybe you held to expiration, which is usually not something you want to do. Or maybe you did get early assigned. As rare as it is, sometimes you will get early assigned on a short option. So you're assigned. Now what? Well, this is not a hard problem to solve. So when you get assigned on a short call, you get put 100 short shares of stock. Just turn around and buy them back to close, right? So let's say you get assigned, your option expires on a Friday, and it finishes in the money. You get assigned short shares of stock, meaning Monday morning, when you take a look at your trading platform, you now have 100 short shares of stock. Well, just sell them back to the market to close the position. That's all you have to do. Now, maybe there was some overnight risk or some weekend risk because the markets could have moved in those couple of days. But don't worry about what the market did, because maybe you lose a little money on the short shares of stock when you have to buy them back to close. But remember, you still had the long call option. So whatever you lost on your short shares of stock, chances are you made some money on the long call option that's still in your portfolio as well. So it's not a big deal. A lot of people imagine that this is something very risky and something very dangerous, but it's not. If you get assigned, it's not the end of the world. You get put short shares of stock, just the next day, close the position. One last thing I do want to mention, because people will ask about it, is yes, you could theoretically exercise your long call option prior to expiration to get long shares of stock. And of course, now you hold 100 long shares of stock, which will cover a possible short call assignment. But that's never a wise thing to do, because you never want to exercise a long option early. We've talked about this before as well. You never want to exercise a long option prior to expiration. If you do that, you're actually giving up money. You give up any remaining extrinsic value on that option by exercising early. So it's pretty much always a mistake to exercise a long option early. So don't do it, right? So I know some people may think, well, the day before expiration, I still have the long call. Let me just exercise it to get the shares, and then I don't have to worry about what happens to the short call. Again, that's just a bad idea. You're giving up a little bit of money when you do that, and I think that's just a bad way to play. So there you have it, a very quick and cursory overview of the poor man's covered call strategy. Fantastic strategy, and it's one that you can actually make quite a bit of money on if things work out well for you, because you go buy that really far out long option. You go buy that long call, say at 120 DTE, and then you sell the short call at 30 DTE. Maybe that short call profits kind of quickly. Maybe you take it down to like 15 DTE. You've already made 50% of your money at that point, and you close it early. Well, then you just go to another monthly expiration or a weekly expiration. If it's a liquid product, sell another short call. You might end up profiting on 3 or 4 short calls along the way over the 120 days that you hold the long call as kind of collateral. That's holding the place of long stock. So that is the beauty of the poor man's covered call. Now, if you want to learn more about my favorite option strategy, which is the wheel option strategy, check out my book, The Super Wheel Option Strategy, which is available on Amazon. You'll find a link to this book in the description below. Also, if you want to help support my work and also hang out with me the first hour of each trading day, sign up for the DT Options Discord server. You'll find a link to it in the description below. I hang out there for the first hour of each and every trading day, and we talk about possible trade ideas. If you're new to options trading, you can ask me questions. I can kind of show you the ins and outs of various option strategies, pretty much anything that you want to discuss. Take care, guys. Peace.